Welcome to this episode number 92 of Your Next Trade Code today, Friday Sadness. So the market on Friday, like the last 5 Fridays, has been struggling. So that has been a pattern that we recognized since the Trump inauguration around mid-January, where the market, the 0 day to expiry options have been struggling to keep the market doing well on Friday. So we had a couple of days ago the S&P 500 down 1.7%, and that was true as well for the Nasdaq, where the market really struggled. We have different explanations to that. The first one is we had the option expiry, and very much what happens is when the market expired, when the options expired, we do have a change in the market's conditions because the positions are obviously expiring, and the market makers and the market participants are putting new positions. So since Wednesday of this week, where we had the VIX expiry, and after that a couple of days after, we had a change in the underlying position. So we are talking the Greeks that needs to be changed. On top of that, if you're adding bad macro numbers, as we're going to be seeing later, that explained why, these Fridays the market was down 1.7% for the S&P. But as you can see, this is not only the tariffs that we had before. Many actors don't want to be very long going into the weekends because you don't know with the new administration what could be happening. But let's look at the year-to-date asset performance. As we can see now, the Russell is down on the year 1.6%. S&P only 2%, Nasdaq underperforming. Very strong Europe still. We saw a lot of inflows going into European funds, both in ETFs and mutual funds. So that explained a lot those flows, why this market is doing so well in Europe. We had as well emerging markets which have been struggling. I'm talking India. China has been doing much better, as we're going to be seeing later. Currencies, with the dollar still down on the year, roughly 1 to 2% versus currencies, we should be keeping an eye on the dollar yen. So dollar yen now is below 150. And if you remember correctly, at the start of August, when we had a risk off due to the carry trade, the dollar yen moved rapidly from 160 to the lows 140. So keep an eye on it, because very often when the dollar yen is moving, stocks will follow. And as you know, we had this long carry trade for years and years due to the cheap financing coming from Japan. And we had this big difference, this carry trade. But if you look at what has been happening recently to the Japanese 10 years, now we are at 1.4%. So it's a bit different from the conditions that we had 2 or 3 years ago. So let's look now at the week-to-date asset performance. And as we can see, there has been a risk-off for stocks, from the S&P to the Russell. So the high beta really underperform the overall market. Even in Europe, after being very strong at the start of the week, we finished roughly flattish on the week. Finally, if you look at WTI, now we are at above 2,900, despite, that's WTI here, 2,900, 2,950. So the risk off is really going into the gold as well. So I'm interested into the week-to-date industry performance. And as you can see, we have some big underperformers here. We are talking online retail, cloud, internet software. So the high beta stocks have been really struggling. The tech stocks, interestingly, home builders have been pretty weak as well. So that is a space we are keeping an eye on. Last year, I've been pretty wrong. 18 months ago, I tried to short it way too early. But, most of the home builders data that are coming out are not that great. And actually, if you look at the toll of this world, Toll Brothers, if you look at the price action after the earnings, that was pretty weak. Other end of the spectrum, you are having all the names that are expected when we are in a risk-off market. You do have like pharmaceuticals, you do have like consumer staples, gold, utilities, anything that is defensive, as we can see here, has been doing pretty well. So the defensive sectors have been doing their jobs, and the more aggressive the cyclical ones like consumer discretionary, technologies, industrials, materials. So what does it tell you? The market is now expecting growth to be coming down in the US. So we had 2 months of this is the new Trump administration, it's going to be great. But actually, Friday, these last 5 days, I've been telling you that the cyclicals are doing not as good as what I was expecting not so long ago. So there are questions on the growth going forward due to tariffs, due to Dodge as well. And you see some big guys now that are telling, the US economy is not going to be as strong as expected. And if you look as well at the expectation for Q1 GDP, we were in the 3% level. Now we are below the 2% level. So growth is coming lower versus the previous quarter. So what about the 10 years? Now the 10 years is coming off as well. So the 4.4 on the yields. It's pretty much the same story where, when you have this risk off, you go for bonds. So we have quite an okay move for the week. We went from 460 from 443. Looking at the Fed expectations, what is the market pricing going forward for the Fed cuts or not? If you look at December now, we are pricing roughly 2 cuts. So that has been a bit less than the 2 cuts. But, the first cut will be roughly around that summer. VIX now, volatility, interestingly, volatility is at 18%. If you remember correctly, recently, each time we had a 1.5 to 2% sell-off, the market, the volatility went through the roof. We went to 22, 23, or 25% even when we had a bit of a sell-off. This time, we had a spike in volatility, but it's not as big as before. So to see more volatility coming, more implied volatility, we need to have a stronger sell-off. So let's move into the technical analysis, looking at, as always, with the S&P 500. As I've been telling you, this 6100 to 6150 is a big level to me. I'm still short those put spreads, so I have the March, but now actually just before the sell-off, I've been a bit lucky. I've been adding to the May. So I've been doing on the SPY 58 to 56. So that will be 580 to 560 put spreads, where I think the risk reward is pretty good. We are talking almost 9 to 1. And I think, as long as the price action, as you can see as well, due to the OPEX, you'd have a much higher volume. If you look at the NASDAQ, because of the high beta, the move is even bigger. If my Bloomberg is keen enough to update. No, it doesn't want. Yes, this is the NASDAQ. So you see the sell-off that we had, and actually I should go into back into the S&P. I don't know why nothing is updating. So you have really this strong level. We have been trading sideways for 2 to 3 months. Now, if you look at the dollar yen that I mentioned, now we are trading into and below 150. So to me, this is really something to be looking at. If you remember, so this is at the start of so that was over the summer here when we had the sell-off in August. As you can see, this strong move. That is a space that we should be looking, because investors are by definition invested in different asset classes. And when one of these assets is moving big time, that has implication for the rest of the assets. So FXI, why I want to be looking at, because this is for China. We saw as well BABA was very strong on the week, so they are their earnings. The stock went from literally $80 60 weeks ago, 2 months ago, to now roughly around $45, $150. So very strong. And FXI, so China is doing very well. We are back to the level that we had at the start of October. So let's see if we're going to have some follow-up. These days, everyone is saying that they are short NASDAQ and long China. As always, be careful. Another one that I want to be looking at is looking to the high beta Momo from Goldman Sachs. So those ones will be a basket of stocks that are high momentum that is created by Goldman Sachs. And as you can see for this week, what happened is everything that was a bit dodgy, the high beta stocks, we are talking the Carvana of this world, the Palantir, the stocks that where we are huge expectations on very high valuation, mostly pushed by retail traders, have been really struggling. And this is the same for the high short interest stocks. So that tells you that what we saw a month ago, or even 2 weeks ago, of all the retail traders buying a lot of stocks, so there was a lot of inflows. They are maxed out in their exposure, and when you start to see a sell-off, guess what? There is a margin call. So those names are telling us a lot about how the market has been doing most recently. The sell-off is telling me that retail have been under some pressure for this week. We're going to see if we're going to have some follow-up into the next few weeks. Walmart, as I mentioned last weekend, this is the high PE stocks, which came with kind of okay earnings, but the expectations have been way too high. So we went from the 105 to actually closing below 95. And as you can see, huge volume on Thursday and Friday. Why? Because we're going to see later that the valuation has been going through the roof. So let's start with this week. What happened for the S&P 500? So this is your sell-off that you have here. Many reasons, as I said. You do have like the option expiry that happened just before on the open of the US market. So this is for the futures, for the options. And then you have two numbers that explain some of the sell-off. First one was the flash PMIs from the US, where actually for the services, we are below 50%. So that tells you that really 70-80% of the US is really struggling most recently. As well, we had some expectations for inflation through the University of Michigan that if you look at the 1 year and the 5 years expectations went much higher. That is partly explained because of the Democrats' perception of the economy has been much worse since the election. But what does it tell you is growth expectation is coming down, and in the meantime, inflation expectations are going higher. So this is not a good combo for the equity market, and that explains partly of the sell-off that we had on Friday. But mostly to me, this is option expiry and the reset of the position. So OPEX, this is done. We had, as we said, Baba just before, flash PMIs, higher inflation, and finally, I want to look again at Walmart, because here this is the price of earning of Walmart, which went from in 2019, 2020, around 2025 into the low 40s. So what has been happening in this market is true not only for tech, but it's true for the big names. Investors have been really concentrated into very few names, and that's true across sectors, across industries. If you have a perception that this company is better, you're going to be paying a high premium. And that comes with a double whammy when the market is in risk-off mode due to the high beta. Even if you consider that those stocks are very high quality, they will be coming down much quicker. So if you look at Walmart for this week, we are down 10%, whereas the market is down 2%. So that explains partly about those market conditions. So what about the catalyst going into this week? So we do have the German elections, so we're going to have the outcome today, on Sunday tonight for Germany. The consensus is actually that there's going to be, that the big parties so far will find and could be leading Germany altogether. As always with the recent elections, we should be expecting some big moves and some unexpected things happening. So as well, we had a very strong Europe year to date. So I think there is a risk of disappointment for the overall market. We do have as well Europeans that are traveling to the US trying to find consensus for Ukraine. So at the start of this week, we're going to have Macron from France and Starmer from the UK talking to the US. So this is a bit for geopolitical. We do have a big number, I should say a big earnings. This is NVDA on Wednesday after the close. Most recently, this is how the stock has been doing in terms of realized volatility. This is the implied volatility. Last earnings, it didn't move that much. The one before, it just went into the straddle, meaning the implied volatility for the overall market. There are more and more talks coming from, for example, from Microsoft reducing their exposure to new data centers. So I think it's going to be a very interesting earnings for NVDA, where actually the stock have been doing sideways for months. On one hand, you do have like the capex from the big tech companies. We are talking 70, 80 billion for for most of them on an individual basis. And on the other hand, you start to see some headlines that actually the capex is reducing. So NVIDIA, as always, this is a big driver for the overall market. We do have a bit of seasonality for this market. So on Friday morning, when I prepare this video, that was before the sell-off. What is very true is looking at the S&P 500 seasonality. And as you can see here, from roughly mid-February to mid-March, meaning from the option expiry on February to the option expiry in March, the seasonality is not that great for the overall market, for the S&P 500. Most of the time, on average, if you look at over the last 25 years, we are down 2 to 3% between the two. So far, we did almost half of it, being down 1.5 to 1.7%. So this is your seasonality, not great for the next few weeks. We do have as well a bit more macro data with the PCE on Friday. So this is for the inflation as always for the rest of the months. And other than that, we do have always at the end of the month some bond supply coming. As you see, this is not, the duration has been reduced a bit, and I think the Trump administration has been pushing pretty hard to reduce the duration of bonds that are offered, meaning the maturities is coming lower because, the lower is your maturity, the lower should be your cost, but that means you are rolling more often your bond. So even if it's a short-term gain, that could be a long-term pain. But I think at the moment, this is what the Trump administration is trying to do. Finally, we do have like the end of the month, meaning that there's going to be some rebalancing for mutual funds. There's going to be some rebalancing as well for rolling off options positions. So we could see some funny moves next Friday. We already got some pushy moves on Fridays, but this one coming this week is going to be could be even more pushy. Finally, S&P weekly straddle market is expecting a 1.7% move up or down. This is roughly what we had only on Friday. So really volatility so far has been very compressed, and that's something that I should have been saying to you, is coming into this expiry, the realized volatility. So what you can do is on an Excel spreadsheet, or you do whatever you want, but on Excel spreadsheet, you look at the S&P 500 and you look at how has been trending the 10 days, the 20 days realized volatility for the S&P. And most recently, it was below 10%. So really the market was very quiet during sessions. Why? Because as I said, we were going into the option expiry. When those options are finally expiring, you do have the power for having more, let's say some more capabilities for the market to be moving both ways. So this is what has been happening. Suddenly on Friday, we saw the volatility going higher. Let's see if we're going to have some follow-up. My view is still the same. I think the US economy is not as strong as what people were perceiving not so long ago. And that tells you that expectations might be coming lower in the next few weeks. So this is it for me for this week. As always, if you are interested in the process, you can subscribe to the 4x4 video series. We do have like mentoring with me and Etienne. So we are doing a dual mandate if you want to. So that's something that is building very strongly. We have the trading community where we have free channels. This is on Discord, and we have more advanced channels where you can subscribe beyond a paywall. Finally, any questions, you can send me an email at greg@dupont trading. That's it for me for this week. Have a good trading week. Bye-bye.